Hello and welcome to this budget special episode of CNBC TV, ICICI Prudential Asset Mutual Fund and CNBC TV 18 present Smart Investor, an exclusive e-forum where leading voices from the industry tell you how, they share their insights and tell you how you can use mutual funds to achieve your financial goals through simple and relevant solutions. They will also help you navigate the complex world of investments and tell you about the various changes that constantly take place and how you can adapt to them. So to help you on this journey towards achieving your financial goals, I have with me here today Chintan Haria, who's the Head of Product Development and Strategy at ICICI Prudential Asset Management Company. Thank you, Chintan, for being with us here today. And before I start my question answer session with Chintan, I would like to thank all those who have joined online and are watching this right now. And at the end of the session, you can post your queries on the Facebook live comment section, and Chintan will answer them for you. So thanks so much and stay tuned to the session. So Chintan, let me begin by asking you, now, COVID-19 has caused so much of disruption everywhere, and it's only but natural that it's also upended a lot of the financial planning goals that people have set for themselves. So do you think that there is a need to for people to completely revisit their financial planning goals?
Good afternoon, Santosh. Big hello to all the viewers. This is the first interaction in 2021, and I think it's been a great start to the year. I think the budget which was there on Monday also has showed the glide path towards a growth-oriented Indian economy, which is a great thing. And government has brought out everything that it can in terms of ensuring all the great potential that India has can be exploited in the next few years. On the COVID-19 itself, and is there a need to change anything? The beauty about financial planning itself is that no matter what happens, you don't need to change your plan. A plan itself should consider the potential ups and downs of the markets. And that's where we believe that if you actually jot out a plan which is proper, which is well thought of, you will not have to worry about not just COVID-19 led falls. There will be many reasons why the markets can go through its ups and downs, right? Both equity as well as debt. And if someone is investing in gold and real estate, I mean, all markets can go through ups and downs, not only because of the pandemic. Pandemics happen once in maybe decades, but the ups and downs in markets happen because of many reasons. So the financial plan should be very simple. It is something which you should stick to discipline. And more importantly, we spend a lot of time thinking about, okay, I want to buy an XYZ phone, and we spend a lot of research and development time of ours in terms of buying a simple phone. But in terms of our own finances, how much time do we actually spend in trying to, jot out the financial plan? You will need definite expert help in that. And that's where financial advisors, relationship managers, whoever you interact with, they can help you chart a course which will be good for the long term. So it's not necessary that because of COVID-19 you need to change anything. In fact, if it's a proper financial plan already set up, you will not have to worry about COVID-19 at all.
Thanks for that, Chintan. And now, as far as asset diversification is concerned, now there are the two schools of thought. One which says that if you take concentrated bets, the risks are higher, but also the returns are much higher. But the other school says that it's best to diversify your assets. So what are some of the things, what would you advise as far as asset diversification goes? What are the things that a person needs to keep in mind while going in for asset diversification?
So clearly diversification is an important to ensure better risk-adjusted returns for the investor. When we say risk-adjusted return, pretty much like you said, one of the follies of investing is we always look at the past returns and invest. And that's when majority of the money which we have ends up in assets currently, which have done well in the last 1 or 2 years. That is not the right way to basically allocate. And that's where if you have a disciplined, diversified plan, wherein say, for example, you have 45% in equity or 40% in equity, 40% in debt, 20% in say bullion. I'm not saying this is the right metric for everyone, but say 40, 40, 20, just as a theory. Then you stick to that discipline and it will ensure diversification for you as well as ensuring long-term wealth. Now within equities, again, There may be diversification required in terms of geographical diversification as well as market cap diversification, which is very intricate, and that's where the help of a financial advisor would be required. But to keep it very simple, diversification does not mean we end up having everything under the sun, because that means you are basically getting market returns. Diversification means that based on the future potential of any asset class and also looking at the business cycle, you basically today allocate the right amount to the right asset class. That's what diversification is all about. And it's something which does not naturally come us in school or college, and hence we require financial expertise or help to set up that plan. And diversification is important, like I said, because for example, if someone was 100% in equity in January 2020 and March 2020 happened, you wouldn't have been able to allocate more to equity because you're fully invested in equity. So if you are diversified, you will be basically, you will be able to allocate more to equity when equities fall, and that's the whole concept of asset allocation, which becomes extremely important.
So Chintan, time to time there are different kind of products which come into the market. Then there are also policy changes, and these sometimes tend to unsettle investors, and there's always a left out feeling at times, and so people tend to react very quickly. So both in terms of newer products and policy changes, what would your advice to investors be?
So of course, policy changes are something which you cannot plan for, because it's totally dependent on the government's priorities at different points of time. And that's where we should have a plan which does not get too impacted by policy changes. But for example, the current budget, which was clearly a growth-oriented budget, which had a very different glide path compared to what the previous budgets had, right? Previous budgets were very focused on ensuring fiscal deficit is in control, government does not spend too much. But in this COVID environment, the government said we are going to spend a lot. They've spent a lot in the last 12 months. They're going to spend a lot more in the next 12 months, focusing towards growth. So that does impact our overall allocation. But if you have a long-term horizon and you have a plan set, then you may not need to worry too much about the allocation part itself. As far as newer products are concerned, we do have a lot of new products which would keep coming across asset classes. Again, all new products may not fit into your basket. At the same time, there may be some products which will have a definite fit into your overall portfolio. Let's assume that in the current equity portfolio, you have good quality, high quality, large cap oriented tilt. And as we know today, based on the budget, the next 2 years, 3 years, the market's going to see, because of GDP growth. I mean, the expected GDP growth is 14.4% nominally next year, which means that a broader set of the sectors can do well. There will be a wider participation. So you may need to have certain cyclical or business cycle elements into your portfolio as well, which essentially means that diversification can definitely come in. So you basically may want to reduce the assets in high quality or in consumer names which have already done well, and you may want to move to cyclicals. That shift is already been happening in the last 4-5 months, and this is the kind of small tweaks which can happen as far as your new product and integration of the new products in your overall portfolio is concerned. Otherwise, new products which you don't understand, which you can't simplify for yourself, that's something which is best avoided.
And Chintan, we just spoke a short while ago about diversification of asset. Now, what about asset allocation? How does an investor decide which are the assets that he should be putting his money into?
So traditionally in India, we've seen at least till 2013, because inflation was very high, the real assets, which is essentially real estate and gold, were seeing a large amount of incremental investment from an Indian savings perspective. After 2013, there was a policy shift wherein financial instruments definitely started to get a lot more interest. And today, as things stand, in fact, financial investments is something which people are comfortable with, given that real estate has had a cycle which has been negative for the last many years. Now, again, it is picking up. So I think all four broad asset classes, equity, debt, real estate, and bullion, have their cycles. Real estate is a longer cycle, bullion is a slightly shorter cycle, equity is a very short, and debt is more a steady asset class for long-term compounding with limited variability. What should be the goal and what is the goal which you are trying to save for, that actually determines what should be your diversification. Earlier there was this rule of 100 minus your age. I don't think that rule anymore applies to the current environment, because the current world environment is extremely fluid, with central bankers intervening at whatever problems come in and trying to solve those problems. So markets are not steadily compounding. There are significant upsides, then there is sharp downsides. And that's where we believe, instead of diversifying or having your own asset allocation, the entire category of dynamic asset allocation schemes or balanced advantage fund schemes category is something which fits an investor's overall portfolio far better, because they don't have to worry about where should they invest, because the market's moving far too fast compared to you doing your allocation and trying to change it. So if a professional fund manager is trying to change your allocation for you in a tax efficient manner in the scheme balance advantage fund category or the dynamic asset allocation category, that seems to be a better fit than trying to have your own allocation. As far as real estate and gold is concerned, I think now we are at a situation, because of low interest rates, gold, at least because of higher inflation expectation, should also be a risk hedge as well as an inflation beating allocation. And that's why we also believe that 5 to 10% of your allocation, if it's in gold, it's something which you can have. So traditionally, Indians have been underweight equities because of the volatility. I think to beat that volatility, the dynamic asset allocation or the balance advantage fund category fits in well. Debt is something which is a steady state. I think Indians have been investing in debt for a long time. And gold via the ETF or the SGB can be invested 5 to 10% for the next maybe 2, 3, 4 years when inflation sits in and this easy liquidity continues. Gold may have its own space in the next 3 years to have up room.
So Chintan, when these kind of financial crises strike, now what we saw in the last year was, something that hit households across. But often there are cases when, some kind of crisis is more specific to individuals. Now, conventional wisdom says that you shouldn't really stop your financial planning even when there's a financial crisis. But that's not always easy to do every time. The magnitude of the crisis may vary. So what are the 2 or 3 things that you should try and somehow sustain through that? What would you advise there?
So clearly the first advice, and it's reminiscent of what I've been hearing my parents say since I was a child, that today's savings is tomorrow's earnings. So in the good days, if you basically saved a lot, it definitely helps in the bad days. The pandemic was something which, because of the lockdown and the commensurate shutdown of most businesses, meant that earnings potential went almost to zero for some and very negligible for many. And if they had not saved when the going was good, it kind of causes a big issue when the pandemic kind of situation happens. Now, pandemic is obviously very rare, but the thing is, simplified, save when you can save. More importantly, what you've saved needs to be invested in the right manner. Now, look at the difference between, say, India and US. If we look at India's savings, only 7% of our overall savings, or around 7% of our overall savings, is in equity, while India is one of the largest, fastest growing economy in the world, and Indians need to allocate to equities, because essentially in an inflationary environment and in an environment where the prices of goods and services are going up, plus because of the pandemic, the big are probably going to get bigger. The listed space is something which may see a lot of foreign investment as well as local investment. So you need to participate a lot more. Today, out of the $7.5 trillion wealth that we have, only 6 or 7% is in equities. Compare that to US, where almost 35 to 40% of US savings is in equity, because of the way they've been always investing their financial, their pension assets or their provident fund pension assets in equity or in the balance category. So clearly we have a gap to bridge. Indian equities in the long run have a scope which should definitely mean that it should be a part of investors' portfolio. Again, here if we see last 1 year returns, there have been ups and downs. So equities is for the long run. The longer you keep, 5 years, 10 years, 15 years, the power of compounding will help you. And because it's an asset class which is volatile, you need to be in the right product as well. So don't just take my word for it that, okay, we need to invest in equities, I'll go all in today. That's not how it is. But make a plan and systematically invest. Today, courtesy digital growth, or courtesy the ease of investing, you can sit at home, plan, and start investing via a systematic investment plan in the schemes which you feel comfortable with, and in the long run accumulate enough units which will help you achieve your goals, shorter term goals, longer term goals, and because inflation is going to go up, the requirement for money for those goals is only going to go up. So with globally interest rates being low and in India interest rates also low, some amount of equity investing is something which I would recommend for investors who stayed away from equity for the long time, and invest for 5 years, 10 years. Don't just invest for 1 year, because in 1 year equities can be volatile, but in 5, 10 year basis, sometimes you will be able to accumulate good enough units even when there's a downturn through SIP. So don't stop your SIP. You mentioned that. Don't stop your SIP. Don't stop your investments. And more importantly, in a COVID-related environment where your earnings itself came down, I can completely understand that you did not have the money to invest. But now that things are normalizing, India is coming back on its feet in terms of all parameters. Again, restart the journey of creating your investments across asset classes.
Now, Chintan, every investor, I mean, there are no investors who don't make mistakes of some kind or the other. So what are some of the common mistakes that you've seen over the years that people make when it comes to financial planning, and how do you advise that those can be avoided?
So mistakes, obviously everyone makes, to err is human. The thing which we can do is learn from it and not repeat it, at least not the third time. You can repeat it one more time because you may have forgotten the first time, but if you don't repeat it, you're fine. As far as what are the learnings or what one should do is clearly, keep yourself updated with whatever is happening, keep the knowledge. Whatever mistakes we make in investing, and the first mistake which I said is look at the rearview mirror and trying to drive a car. You can't look at the rearview mirror and drive a car. There was a time maybe 2 years back where in India, I think Brazil funds were getting a lot of money because Brazil had been the best performing market in the previous 12 months. Investors looking to invest, looking at the past 12 months return is one of the biggest follies, which probably is reducing the ability for long-term wealth creation. I would say keep your asset allocation stable. And the other mistake, of course, is sizing. So in March 2020, when the markets fell very sharply, there would be many investors, and I've come across many, who would have invested a small portion of what their total wealth, which they could have invested in equities. They were happy that that small portion made money, but they could have made a lot more. And that's where, again, I come back to the point that investing in the dynamic asset allocation, the balanced advantage fund category, helps them overcome this greed and fear, because you may not know the magnitude to which the market has become cheaper. You may not know the magnitude to which the market has fallen, and we all freeze. The biggest worry, or the biggest, let's say, the learning is greed and fear strike when it hurts the most. So today, probably at the market highs, we'll all be greedy and we'll be happy to invest. It's natural, right? Because we don't see the fear of failure or the fear of markets falling. And when the markets in March 2020 had hit a low, we all were fearing that because of COVID, everything is going to shut down and market is going to shut down. While actually at that point of time, the market cap to GDP was 65%. Today, the market cap to GDP is 100%. So if I look at various parameters and metrics, India's growth means that there is money to be made, but it does not mean that you go all in today. And that's where I would again repeat, the balanced advantage fund category or the dynamic asset allocation category should be something which most investors should start with as far as the investing journey is concerned. As far as debt is concerned, we believe obviously in debt markets today, there is, credits are something which are still priced higher than the high quality. So the funds which have a good mix of credits are something which they can be looked at.
So Chintan, how would you advise investors to use mutual funds for the tax planning purposes?
Yeah, so I think first thing, as far as mutual funds are concerned, just as a primer on taxation, much like in an individual stock, when you invest, if you invest in an equity-oriented mutual fund, you end up being taxed like a stock, which is essentially if you hold for less than 12 months, it is 15%. If you hold for more than 12 months, it is 10% plus some surcharges. It's exactly like a stock. So that's one advantage which you get. As far as tax planning is concerned, under Section 80C, there is one ELSS category, which is essentially the equity linked savings scheme, where as part of the overall 1.5 lakh, you can also invest in the ELSS category. We've seen investors start their SIPs in the ELSS category as part of their tax planning. It ensures that they don't invest in one bulk in one go, at the end moment. So say, for example, you've decided that you need to invest 75,000 rupees in tax planning because the other 75,000 is being taken care of by Provident Fund and your insurance investments, etc. If that 75,000 has to go in equity and ELSS, you can spread that 75,000 over 12 months via SIP so that you don't have to invest in lump sum. At the same time, you don't have to worry about forgetting it in February, March. Typically, we all, in February wake up and say, okay, I need to invest. That may not be the right, outcome. Look at it this way. The last 1 year markets were much lower than today. And if you would have invested at every go, you would have been much better off than trying to invest that 75,000 in one go today. So I would say that ELSS is one of the ways of, again, getting a tax benefit under Section 80C. There is a 3-year lock-in, so you cannot remove that money for 3 years. But I would say that consider equity allocation, and I've seen enough number of investors who once they've invested in ELSS schemes, they tend to stay longer as well. So that's one of the ways. On the debt side, again, there is a taxation advantage which is there, which probably I'll cover later. But as far as tax planning is concerned, clearly ELSS schemes from an equity tax planning perspective fit an investor's portfolio very well.
That was the next question I was coming to, Chintan. So what is ideally a good horizon as far as ELSS is concerned? Because many investors use it purely for that for 3 years and then they don't look at it after that. So what would you advise there?
Yeah, so if something is forgotten, it sometimes reaps better rewards is what is essentially the key over here. And hence, when investors do invest in ELSS, they don't look at it they can't remove it for 3 years, and after 3 years, they probably do not look at it that actively, and it stays for longer. And eventually, we've seen enough number of investors who invest in ELSS schemes that not just for the 3 years, they keep it for longer and take the advantage of markets, growing over a period of time. So it is essentially inculcating the habit of long-term investing. If for example, this 3-year lock-in wouldn't have been there, there would have been always this urge to take out the money after 12 months, etc., which again, when the markets fall, you take out money, it may not be good. And this, once you stayed for 3 years, then probably, you are more stable, you continued for it. The thing which always comes to my mind is that if you are in a business, if you're running your own business, you rarely want to sell that business in 6 months, 12 months, right? You want it to grow, you basically nurture it, and then you maybe even if you want to sell it, you sell it at a big profit if you want to. Similarly, in equities, when you're buying or when you're investing in equity-oriented mutual funds or you're investing in equity, it's essentially you become a part owner of that particular stock or that through the combination of stocks which are there in the mutual fund. And when you become the part owner of that, you don't want to let go of it. You want the profits to grow along with the businesses, and hence the longer you keep it and the longer the business does well, you obviously do well. Now the key over here is professional stock selection and also analysis of underlying stocks, which does not naturally come to all of us, and all of us may also not have time to do it. And that's where you spoke of diversification earlier. When you're investing in an equity-oriented mutual fund, you're getting a combination of maybe 25 to 40 stocks diversified on sector basis, on stock basis, in a diversified portfolio. That's something which helps risk-adjusted return in the long run because you're not putting all your eggs in one basket. In other words, you're not betting a large amount on one single stock, which can always have variations because of technology change or a competitive environment or a regulatory change. So I would say that keep focus on the long run, invest in the diversified fund, and ELSS schemes are exactly that, right? They give a combination of 35 to 40 maybe stocks in large cap, mid cap, small cap. It's a stable portfolio, and over the next 3 years or 5 years or 10 years, you participate in the market growth along with the ELSS schemes.
Okay, so how does one select the right ELSS scheme? What are some of the pointers that investors need to keep in mind while selecting it? And another specific question is between large cap and let's say mid cap focused funds. What are the key things that investors need to look at while investing?
Yeah, so typically ELSS schemes in India, most of them at least, are diversified across market caps, and that's how it should be. So I would say that given ELSS is a long-term horizon, having a diversified portfolio would be one of the check boxes that I would see in an ELSS portfolio. If it is pure mid and small cap, it can have its ups and downs and can have a lot more volatility. So if it's a pure mid and small cap ELSS and you invest in March 2020, you do get a good return over the next 12 months, 18 months. But if you do invest something in 2017 when mid and small caps were high, in a pure mid and small cap ELSS, it can come down. So I would say that first check would be that it should be a diversified portfolio which has large cap, mid cap, and small cap, all three, and the fund manager keeps changing the proportions, that would be something which I would see. Most ELSS schemes have 50-60% in large cap, which is how the diversification comes in the large, mid, and small cap category. So that's something which I would say. Other than that, of course, more than selection, it is about allocation. So the investor has to allocate and make the decision wherever they are comfortable with, whichever fund house they are comfortable with, they can invest. The important is long-term steadiness, and I think the longer term, if you see that for the long term, the steady ones are the ones which have a good balance of large, mid, and small. So I would say that discipline of investing is important. Within this selection, you can pick and choose the one where you have a diversified portfolio. And again, here I would say that the portfolio should not be tilted in favor of either mid cap, small cap, or it should not be only high quality, because it can end up, doing well for a few years and then probably not doing well for the next few years. So you'll have to probably actively manage it. So a diversified portfolio is good enough for the investor. Important is to invest. Where you invest is probably a lesser of a question.
And what is your view on lump sum investment in ELSS? Should they be avoided at all?
No, I think, see, if March 2020 kind of a scenario happens and investor goes in for a lump sum investment, say on first week of April itself, first week of April 2020, for the next day if they wanted to invest because markets were much lower, it's completely fine. The ideal way to have a plan is that I have an SIP going. So let's say, like I said, 72,000. So if you divide by 12, say 6,000 is going every month. And an event like March happens. So while in March 2020, my requirement for ELSS would have been taken care of because 6,000 is getting more. In April 2020, you could have preponed, your 12 SIPs and invested in April. The markets were much lower. So that's something which you can do at best in terms of lump sum investment. I would always believe that having a systematic plan and having investing is great. But if you do have months where you see a sharp fall in markets, you can prepone your next few months of investment, or at least this year's requirement you can prepone and take advantage of a falling market. Because if you only wait for the lump sum for the right time in the market, none of us know actually if the markets are going to fall and give you that right opportunity in a particular timeline, which is essentially 31st March of next year, by 31st March of next year.
So the budget has done away, brought ULIPs and mutual funds on par by, doing away with the tax exemption on maturity proceeds. So how do you see this as a development for the mutual fund industry? Do you see more money coming into mutual funds now as a result of this?
So if you look at India, the financialization has a long way to go. So I think there is scope for all potential products to go, to receive money. The tax rationalization or tax parity across products is something which will evolve over a period of time. But I see that it is more important to get investors to invest, and that's where all the modes of equity allocation from Indian investors are going to see growth. One versus the other, I wouldn't want to compare because we are still minnows as far as our overall equity allocation is concerned. If you put up all, insurance, asset management, equity, everything, if you put up, our retail and HNI investors are a very small part of the equity pie in India. It's basically, if you look at it from 1991 to today, foreigners have basically got 21 to 22% of our overall equity, while promoters own 50-52%. So 70-72% is between foreigners and promoters, and the rest is basically between the retail and HNI and other corporations. I would believe that with growing understanding of financial products, all financial products will grow. I don't normally want to invest looking at the taxation. I want to invest looking at where it fits into my overall allocation. If the taxation is beneficial, that is an added benefit. But I would look at costs also. So if the costs are lower, great. But it is important to allocate to the right asset. Then within the right asset class, things will basically take care of itself.
Well, thank you, Chintan, for all those insights. And now we'll be taking some questions which our online investors have posted on the Facebook Live comment section. So we have a question here from Sarang Jetli. Says that, can you please suggest an ideal portfolio allocation for a 5-year horizon for an aggressive investor?
Okay, the definition of aggressive and conservative changes with the market sometimes. I've seen enough aggressive investors turn conservative when the market fell in March 2020, but I assume Sarang wants to remain an aggressive investor and has a horizon of 5 years where he'll not need the money which he's going to invest. So with a 5-year aggressive for an aggressive investor, I would say anywhere between 60 to 70% in equity, maybe 20% in debt and 10% in gold or 15% is gold would be the right allocation. This again is a ballpark figure, depends on investor to investor, but 60 to 70% in these markets would still be aggressive considering that most are below 10 to 20% in equity.
Okay. There's a question from Vishal Sharma. It says that with markets at an all-time high, should investors make investments at these levels or hold back?
Yeah, so there are two things of investments which should be, very kept in mind by the investors. One is when you have the money, you should invest. Where you invest and how much depends on the market conditions. Of course, all-time high was spoken of. I've been in the industry for 15 years after my chartered accountancy. I've seen enough all-time highs happening, right? Sensex, when I joined at 15,000 or 16,000 was an all-time high, then 25,000 was an all-time high, 30,000 is an all-time high, now almost 51,000 is an all-time high. So the thing about markets or these numbers is that it is a combination of the economic activities, reflecting of the economic activity, and it's an indicator of the GDP itself. And what is GDP? Essentially the sum total of all the activity of listed players, government, net exports, etc. So if you believe, and I believe, Vishal, that we are from 3 trillion, we are going to go to $5 trillion. We were at $1 trillion. Remember, in 2008, we were at $1 trillion economy, but our GDP, our market cap was $1.6 trillion. Today, we are at $3 trillion economy. Market cap is roughly around there, around therein and thereabout, slightly lower than $3 trillion. And in maybe 4 or 5 years' time, we'll reach $5 trillion. So if the $5 trillion comes in, then our market cap basically essentially means the sales and profitability of our companies will grow. Sales and profitability, when it grows, it essentially reflects in their prices and their market capitalizations. And when the market capitalizations grow, the sum total or the indicator, the indices are nothing but indicators of the sum total of the activity. They'll also be higher. So just looking at all-time high, if I stop myself from investing, it may not be right. But where I invest matters a lot. And there again, I would say that the balance advantage fund category and the dynamic asset allocation fund category is something which is a good start for all investors who are looking to invest today. Because today the markets are high. If there is a dip, you can allocate more, which essentially dynamic asset allocation schemes do it. Whenever there's a dip, they increase your equity level from where they are currently. So I think over the last 10, 12 years, we've seen enough number of investors catch on to this investment option in dynamic asset allocation and balance advantage fund. And you may also want to have to, try that out at current market levels, because whether a dip will come today, tomorrow, I don't know. At some point, it surely will come. But we can't wait for the dip. But the investment horizon should be 5 to 10 years. Thank you.
So Mahesh Singh asks, which sectoral funds should I invest in? Looking at some of the policy announcements in the budget.
Yeah, so I think clearly from a budget perspective, the sector which has got the biggest fillip is the banking sector. And we've already seen that happening in the last 3-4 days. Therein, for the first time since the bank nationalization happened, the government is talking about privatization of banks. They've already consolidated, I think, 8 or 10 smaller banks into larger public sector banks. So the consolidation has happened. Now talk of privatization. So essentially, government is saying that the entire banking system, also the talk of the asset management bank or the bank which will take up stressed assets. So all of this are something which was the wish list from a corporate world perspective, which has been given, and that's where the banking system now becomes linear. And we've seen in the past that whenever there is a growth in GDP, which is touted at 14.5%, and there is a capacity utilization which increases, the growth in credit also comes back. And now with a lesser number of banks being in the foray, whatever growth will come in will be probably got by the lesser number of banks. So banking is clear winner based on the sector. It is a sector which is an FI favorite. So when FIs put in a lot of money, banking sector does well. When FIs take out money, banking sector does badly. But in the long run, it is a good way to participate in the economic growth of any country, and that's why banking is about 30-35% of our overall index. It has its own risks, of course, being a leverage sector, but based on the budget, that's one sector. And second is, of course, infra and power. If we look at whatever the budget has spoken about, capital roads, railways, ports, I think infra and power both should do well.
Samar Patel asks if you can suggest the best global funds to invest in.
So I think global investing itself today has become something which is catching the eye of Indian investors, especially those who are well penetrated into the Indian markets or have been investing in markets for long, and they are looking at avenues to invest outside. I wouldn't know the best global funds because what is best is only known in hindsight. But I think a disciplined investing in international equities is something which can be done. Again, don't look at the past returns and invest. I've seen enough investors looking at technology funds today because they've been the best performers in the last 3-4 years and putting money. I don't know whether that continues over the next 2-3 years. It may continue as well, but be mindful that the valuations, etc., also may be stretched because of the past rally. However, we do believe that with dollar depreciation as a theme, Asian economies benefit out of dollar depreciation can be looked at from an investing perspective, while also in US, other than the tech stocks, the valuations are not that expensive. So you can have a good blend of US and Asia investing, but it has its own risks, and be mindful of the fact that you and I sitting in India may not understand all the risks of international funds.
Paresh Singh says, can you please explain the changes in NRI taxation?
No, that's something which I wouldn't probably be able to cover in this discussion. Thank you.
Sorry about that, Paresh. Well, yes, I think that's all that we have in the, as far as the questions from our online viewers go. So, Chintan, it was great speaking to you. Some lovely insights there. And if I can just sum up some of the points that Chintan has made. First and foremost, I think it always helps to have some expert advice in your journey towards planning your financial goals. That's one. And Chintan also says that you just shouldn't diversify for the sake of diversification, because if you go and buy everything, that means you'll just be getting market returns. And also when you're diversifying, it doesn't mean that you just do it based on past returns. Just because a particular asset or a fund has given spectacular returns in the past, you just don't identify those best performing ones and buy it. That is certainly not the way to go about it. Even in financial crisis, in times of crisis, you need to maintain at least some of the regular investments that are going. And when things return back to normal, obviously you should even try to probably make up for that. Also, stay away from some of the products which you don't understand. Those are best left alone. Don't look at the taxation angle, purely go invest in an asset just because of the tax arbitrage probably which is available. You should also base it on what your appetite for risk is and how you assess that asset performing going forward. So thanks for all those lovely insights, Chintan. Pleasure having you, and look forward to having you again on this show. And for all our viewers, stay tuned for the next session. Thank you very much.
Thank you.
दूसरा रन लेने की कोशिश, लेकिन ये रन आउट।
चाचू रन आउट।
कोई जरूरत नहीं थी रन लेने की।
इन्हें तो साथ भेजना ही नहीं चाहिए था।
कौन मैदान पर आता है?
अब अगला कोई एग्रेसिव प्लेयर आए तो सही होगा ना।
अरे अग्रेसिव तो खड़ा है ना स्ट्राइक पे भैया, कोई डिफेंसिव प्लेयर है तब तो जोड़ी बने।
लेफ्ट हैंडेड बैट्समैन की जरूरत है। लेफ्ट हैंड और राइट हैंड का कॉम्बिनेशन बॉलर्स को भारी पड़ेगा।
और ये कैप्टन का सही डिसीजन, लेफ्ट हैंडेड बैट्समैन की एंट्री।
सही जोड़ी ही मैच जिता सकती है। इसलिए जब हो आपका टैक्स प्लानिंग का मैच, आपको चाहिए टैक्स सेविंग्स और वेल्थ क्रिएशन की सही जोड़ी, जो आपको मिलेगी ELSS फंड के साथ। जब जोड़ी राइट तो फ्यूचर ब्राइट। ICICI प्रूडेंशियल म्यूचुअल फंड, तरक्की करें। म्यूचुअल फंड